Now we are celebrating World Investor Week, and World Investor Week is a global campaign to raise awareness of the importance of investor education and protection. This entire week we talk on various investment related aspects, right from investment instruments, investor protection, education and awareness. Let's kick off this week with a very special guest. I have Monika Halan, author and analyst, who will talk today on various myths which are related to investment, the investment process, or the kind of understanding investors have of investment instruments. Monika ma'am, good evening and welcome to the Money Show. And we've discussed this a lot of times via different kind of topic of discussions, but then let's debust the kind of myths generally investors have when it comes to investing in equity markets, or maybe generally the concept or the notion of investment that people have in their mind, because a lot of time Indians are not able to decide whether saving is different from investment. A lot of times it's like a club concept for them. So what is the first myth that you would want to highlight?
Kavita, thank you so much. It's indeed an honor to be and talking about things which matter to investors. One of the biggest things that I have noticed is that people get fixated on return of an investment, which of course is a very important thing, but they forget to think of things like risk, liquidity, availability of money when you need it. So when you think of an investment, it's not just the return that you're looking at. Don't get fixated only on the return. There are other attributes of an investment which are equally important. For example, if your investment is for a shorter term horizon, then more than risk, more than return, you have to be focused on the risk. You need that availability of money. It is in a longer tenure investment that you can take more risk and have a focus on a higher return. So one of the first things that I want to start my conversation with is to say, yes, return is important, but that's not the only thing which is important, Kavita.
All right, let's focus on myths related to specific investment instruments. And over here, let's begin with mutual funds. A lot of time investors think that mutual funds means directly investing only in the share market. What's the kind of myth which is there that investors need to just go away from?
I agree with you. Absolutely. Mutual fund is not a product. People confuse the mutual fund to be a product, a destination. It is actually a pipeline which is connecting your money to pools of money which are invested in stocks, bonds, gold, real estate, and combinations of that. So you invest into real estate through REITs, which is at the moment not so developed, but investing in shares, in bonds, and gold, and combinations of these is the destination for a mutual fund. So when people say that I'm investing in a fund, they tend to think only equity. But you're absolutely right. It's also debt products, and people who understand debt funds are able to use them very efficiently for both their near term and short term needs, much better than what they would a savings deposit and a fixed deposit. So yes, it's one of those major myths that I've done SIP in a mutual fund. Now, again, SIP is a route. It's like a recurring deposit without the guarantee. It's a recurring deposit in a mutual fund. So it's a road into a destination, which then takes your money forward into the place that you choose it to go. So the iterations are many, and you're right, it's not just equity.
Right. One more very important aspect when it comes to the investing in equity. I would like you to explain our viewers the concept of having inflation beating returns and how equity can be helpful, okay? But a lot of times investors also think that maybe if they are invested in equity for a short period of time, then too they can get a hedge over inflation with this particular asset class. Is that true? And if yes, then what kind of a duration that you should be playing along in order to get inflation beating returns from equity?
You're right. Inflation beating returns are possible from equity, but what you need is a large dollop of patience. You need to have a horizon of 7 to 10 years at least. All right. It does take 7 years for a business cycle, for a economic cycle to get over. Especially when markets have been up, and this is what we have seen in the last few years. a new generation of investors comes in, and they are unable to understand that markets go up and down. So they begin to think that 3 years double my money. That doesn't really happen, because there can be long periods of time in which the stock market gives returns which are worse than a fixed deposit. It has happened just before the 2020 rise in markets, just short of that. If you did a 5-year back testing, a lot of people found that their fixed deposits actually had performed better. But then it took a little bit, it just took a few months for that entire flat return to get recovered, and the market did give good returns. So, yes, investors must understand that you have to have a long-term perspective when you come to the equity market. And one of the best ways to get that average market return is through an index fund. We can predict, looking at two numbers, the equity, the GDP numbers and the inflation numbers. You can make predictions as to what the average return would be over a 7 to 10 year period. So typically what we say, it's GDP plus inflation plus something called an equity premium, which at 6% GDP, 6% inflation, you're already reaching the 12% number without even building in the equity premium. So, but to harvest that return, you need patience. Equity is a slow cook. It is not instant noodles. You will burn your fingers if you come into the market expecting guaranteed high returns in the short term, Kavita.
Right. One more concept, which investors are really banking on these days is investing in only mid cap and small cap just to beat inflation, or maybe have high returns in short term. Okay, this is the biggest myth that is the most active right now, Monika ma'am.
Right. No, you're right. And we've seen this whole thing so many times. We've seen the cycle. Investors seem to have an all or nothing approach. And they look at last year's return. They're looking at returns which have already been booked. And then they come into a slice of the market. So instead of an all or nothing, so their questions will be, I'm going to move all my money into a mid cap, or I'm going to move all my money into a small cap. The approach should be, it's a pizza pie approach, or it's an Indian thali approach, where you have portions divided across less risky equity assets and higher risk assets. So typically, if you have half of your equity portfolio in a large cap fund or an index fund, and you do a quarter pie slice each for mid and small cap, you're building in both stability and growth into your portfolio. So investors need to understand that, you've seen the small and the mid caps give great returns, but I can point to so many data points in the past where both of these have horribly underperformed the market, the broad market, or they have given returns which are lower than the Sensex and the Nifty. They have gone into losses. So, timing the small cap and the mid cap will really burn your fingers, lose you money. Please think of a portfolio approach, have half your money in a safer equity asset, and then build your slices of the pizza pie with small and mid cap. So, no, I don't agree that you should rush into these risk assets just because last year or the last 3 years were great years for these places in the market.
Monika ma'am, let's talk about the entire debate of active versus passive, okay? So is it right to say that active always gives you more return than passive, and to earn more returns in a longer period of time, you must just bank on active and just totally ignore passive? What is the kind of myth that goes around between these two way of investments?
So that active versus passive debate is largely related to people wanting to target a higher return than the market index. And what we have seen is that the large cap part of the market has found it difficult to beat the index Sensex Nifty 50. So then the attention changes towards parts of the market which have outperformed these indices dramatically. They have outperformed in the last few years. Again, my suggestion is have a mix of the two. You don't always have to choose either or. In my world, it is an and. So you want to have, passive part of your market can come through an index fund, and the active, where we are seeing still large alpha, possibilities in the mid and small cap, that you can choose through an active route. So your portfolio is a blend of both active and passive, where the low risk part is in a passive fund, low expense ratio, low tracking error, and your higher risk, even within equity, is sitting in active funds, which you have chosen through due diligence. You have not picked last year's winner, but you've looked for consistency of performance over 10 years at least. You've looked for the risk metrics, you've looked at expense ratios. Then you have chosen. You've not chosen because somebody has given you a tip. Should you do all these things, you have a robust portfolio, and you don't have this active or passive debate in your mind. You're saying it's active and passive, Kavita.
Mhm. One last question, ma'am, and then we will wind up the discussion. In fact, there's a lot of themes and topics on this, but then I'm really running short on time. But one last question: are mutual funds risk free? Is this a
No.
myth?
No, of course they're not risk free. Look, again, what is risk free? Is a savings deposit risk free from inflation? It is not. Is a public provident free risk free from the lack of liquidity? No, it is not. So, how are we defining risk? We are defining risk very narrowly in terms of only volatility, which is short term, dramatic up and down movements of the market in terms of the price. Of course, stocks are more susceptible to this volatility than the bond market. Therefore, there is going to be the risk of volatility attached to the stock part of it. But mutual funds, being market linked, the price is marked to market every business day, makes it susceptible to the prices moving up and down. You don't check the price of your real estate, you don't know what's happening on a day to day basis. Things like a fixed deposit in a public provident fund, those are guaranteed return. They are risk free in terms of what you get back. But a mutual fund will carry the risk of volatility. There are other kinds of risk, excuse me, of liquidity, of uh, being sure that the money is there when you want it. So you have to evaluate all of these risks before you get into a financial product. But and absolutely no, mutual funds are not risk free. They carry different kinds of risk. You need to see the face of different faces of risk and then decide which one you can handle.
All right, with that, thank you so much, Monika ma'am, for being on the show today and helping our viewers with this and beginning our World Investor Week with this very important discussion. Thank you
Thanks,
so much.
Kavita.
All right, before we show with me Kavita Thapliyal, let's move on. 73% of investors don't consider risk appetite. 61% don't understand riskometer, says Axis Mutual survey. So how do Indians actually look at risk, be it their risk profile or risk involved in a particular investment or investment instrument? Let's dive deep into this survey. I have with me Ashwin Patni, Head Products and Alternatives, Axis AMC. Ashwin, good evening and welcome to the show. So clearly, the first question is about the highlights of this survey that you might want to share with our viewers, because it's something that about risk you've figured out, the kind of respondents and the kind of questions that been asked. Give us the risk related highlights in this survey.
Yeah. So I think it's a very interesting and I would say first of its kind study where, what we say, typically for many years we've been saying this, the standard disclaimers about mutual fund are subject to market risk, etc., and all those things. But nobody has really made an effort to understand, and obviously we have a number of tools available to show, but nobody's made an effort to understand what the investor's perception of risk and what these various risk tools is. So the context was to make an attempt to reach out to investors to understand firstly, do they how do they look at the role of risk in making these investment decisions for themselves. How do they differentiate between risk which could be at an individual level versus a scheme level risk, and are they aware of some of the tools that are available to them these days, thanks to the standardization that has been created by SEBI, and now these tools are available to people across all AMCs to be able to carry out some of these risk assessments. So We did this exercise where we reached out to respondents to ask them a bunch of fairly straightforward questions around their understanding of risk and risk tools. Um, the top summary that I can say is, and that is the really satisfying thing, is that the overwhelming majority, more than 90, close to 90% of the investors mentioned that uh, uh, one of the very important thing was your personal risk appetite to decide what the investment is, and that is a really pleasing thing, because that is clearly something that people are sensitive about when they are investing. However, the thing that is on the other side, the challenge is that while such a large number of people think that this is an important thing, but within this, a majority of the investors actually are not aware of the tools which are available, whether it is the riskometer, which is the scheme level risk, or the risk profiler, which is the individual risk. These are the tools that people are not aware or familiar about. So that's really the striking key observation from the review that we have done.
All right. So clearly, Ashwin, investors are not aware about the risk protecting measures involved in equity products. So, what exactly do they understand about risk that's involved in any kind of equity product?
So currently, the report was more about how checking their understanding itself. Of course, the way these tools work is nowadays quite standardized and very easy to understand. But I think the challenge was first and foremost to just understand that are people even aware that there are these tools which are available and they can use these tools to their benefit. And as I said, most of the people seem to sort of fall off short there at that stage itself, where while they intuitively know that risk is an important point in the consideration, but they don't really are not aware or familiar with the tools. uh, uh, as a result, what happens is that you typically fall back on the more things which may not be the best things, like historical returns, or looking at some of the other points, which could be more suboptimal. But I think the awareness of these tools is lacking. That's the main point which has come out in the.
So, Ashwin, after understanding the risk profile of a product that you must have explained investors, did you see any comfort level towards equity instruments? Because, once you were surveying them, you might have analyzed their apprehensions, towards particular investment or equity product. After knowing that, were they comfortable or were they able to analyze their own risk profile?
Yes, so I think the fraction of investors who understand this are much more confident of the kind of decisions that they are making, and I think they feel that it is helping them take better decisions. So they, uh, you know, as you know that there are two types of risk that people need to be aware of, right? There is a first type of risk, which is risk of uh, what is their own risk appetite as an individual, and that is what the risk profiler does. And then there is a second part, which is the risk of, as you were asking about equity as an instrument. For example, if there is an equity mutual fund which invests into equity stocks, then there is the risk profile of that particular fund, which comes out in what is called the riskometer, which brings out clearly. So, for example, an equity fund versus a debt fund versus a hybrid fund, you can look at the riskometer, can tell you the variations around the risk levels of some of these products. So, uh, better understanding, to your question, better understanding, it's not just that people want to avoid risk. So if equity, for example, is seen as high risk, then by looking at riskometer and seeing it's a high risk, you don't invest. No, I don't think it's like that. I think what it is that a better understanding of the risk allows you to make a more judicious decision, allows you to make a better decision which is more aligned with your own risk profile as an investor, and which is more aligned with what your goals are. And yes, to your question, people are, once they understand that, they are very happy to sort of continue and on the investment journey and make those decisions.
Uh, Ashwin, any mutual fund related risk specifically that was highlighted?
Not really, because if you see our focus of this survey, it was more about the broad tools which are available, and these are standardized tools. I think that's the most important thing, because it's not about, of course, as we are as Access Mutual Fund are doing this survey, as a part of better understanding of our investors. But it is not that these tools that we are talking about is limited to a set of funds within Axis Mutual Fund or limited to Axis Mutual Fund. Thanks to as I was saying earlier, the decisions that have been taken by SEBI and at an industry level, now these are standardized tools which are available across all fund houses. So it was not about a specific fund. It is not about a specific fund house even. It's more about the fact that there are now these tools available and investors can use these tools to their advantage. That was the focus of the survey that we were doing. As I was saying, just to sort of make a quick recap, I think we are still, as an evolution of our understanding on risk, we are still at a very nascent level. As a broader population, saying. Obviously, some people will be sophisticated, but as a broader population, there is still a level of nascent where we are in terms of our journey, because a lot of people think of risk in a very loose way. They are not able to link their worries or their issues or their perception of risk to a more concrete impact of risk in the actual decisions, and that is where these tools can come in very handy. So the purpose of the survey was really to highlight that there are these tools, and that you should by using these tools you can lead to a more judicious and a more efficient outcome, which is more aligned with the path that you're comfortable taking as an individual.
Ashwin, 66% respondents said that riskometer actually helped them in assessing risk. Now, how exactly do you think they were able to understand riskometer, and what actually came out on from the survey on these lines?
So I think we have to take again a step back to look at that statistic, because what happens is that most people, the starting out itself, are saying that they are not aware of riskometer. So first of all, uh, uh, you know if I were to throw a number, 61% of the investors are not aware of what is a riskometer. Then obviously the balance are. So what you're saying is that the a lot of the investor population is getting dropped off at the initial stage itself because they're not even aware. Then you come to a set of investors which are aware, and then they use this information, and then when they use it, they find that they were helpful about it. So then uh, uh, within the investors who are aware and they used it, they found that it was helping them take a better decision. So that's really the power of these tools, that if you understand what these tools provide you, understand how to use them, and if they are not very difficult, that's the best part. These are reasonably easy and standardized tools. With a little bit of effort, almost most of us can sort of use them to get a broad sense of what we are going in terms of risk. And with that, people, when they take those decisions, that's what the survey is coming out, that people are happier and are more comfortable with the kind of decisions they make.
Ashwin, respondents considering personal risk appetite as a factor while investing in are just 27%. You think the personal risk appetite knowledge is same across investment products, or it's different as per different asset classes?
No, I think it's changed and evolved over time for sure. I think a nation of investors, we have come a long way in the last 10 to 15 years. We've had, of course, a lot of effort, including the mutual fund Sahi Hai campaign, and bunch of awareness initiatives by the industry, by the individual fund houses, to make people more and more aware. I think in the old days, with fixed deposits dominating life, was what's quite simpler for investors, because these were very easy to understand instruments. But as these mutual funds and others come into the mix, there is an element of, while these are great investments, great instruments, but they also require a little bit more, they demand a little bit more effort in terms of the initial understanding and risk that they need to be understood. So to answer your question, yes, I think the journey has been definitely a positive journey. I think people have been more and more willing to go along for the ride. They've recognized the difference. I think we now have a reasonable sort of investee population in mutual funds who have been invested for a period of time. And I think they've recognized that the power of mutual funds is there, but at the same time, there are risks, and there is a structurally they work very differently from your traditional instruments like fixed deposits or any of the other ones. So I think that journey is there. But at the same time, we should not become, I think the most important feedback of the survey is that this is not the time to become complacent. This is not the time to sort of, as a industry, sit on our laurels, or as investors think that because the mutual funds have given over the long term good returns, you can sort of just go and invest in any of the schemes. It is the time now to take it to the one step higher, to make this more and more useful and relevant to each of the investors. Make sure that people are aware of these tools and are using these tools to their advantage.
All right. On that note, thank you so much, Ashwin, for taking our time and helping all the nitty-gritties of this report of survey with our viewers today. All right, we move on. With the start of October, new TCS or tax collection at source rules have kicked in, which will impact various financial transactions, including international travel, investments in foreign assets, and educational expenses abroad. My colleague Sneha Shah joins in to help you navigate with this upcoming change.
Well, yes, under the RBI's liberalized remittance scheme, you can remit up to $250,000 in a financial year. From the 1st of October, all overseas outward remittances except for medical and educational purposes over a threshold limit of 7 lakh rupees will attract a TCS of 20%. Let's look at the different types of transactions in detail then. Education, under LRS, there will be no TCS on foreign remittances below 7 lakh spent for educational expenses. If remittance above 7 lakh spent for foreign education is through a loan which is obtained from an approved financial institution, it will attract TCS at 0.5%. However, remittances above 7 lakh not obtained through a loan will attract a TCS of 5%. Now, the second is medical treatment. Any outward remittance for medical treatment will attract TCS at 5% if the threshold crosses 7 lakh rupees. The third is travel. On the purchase of overseas tour packages of up to 7 lakh rupees in a financial year, a TCS of 5% will be applied, and beyond that, a TCS will be applicable at 20%. Now, there's also some relief coming in because payments by credit cards do not fall under the ambit of LRS. Hence, there will be no TCS on credit card transactions. However, payments by debit cards or forex cards come under LRS. So if you spend 7 lakh rupees using a debit or a forex card, you have to pay TCS at 20%. And lastly, investing more than 7 lakh rupees in foreign stocks, mutual funds, cryptocurrencies or property will trigger a 20% TCS. However, domestic mutual funds with foreign stock exposures are exempt. So that's a snapshot on the new TCS rules.
All right, on that note, let's take a quick break, but then post that, we'll be joined by Pankaj Mitpal, who will be answering your mutual fund portfolio queries after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and that's the last leg of the show where there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have Pankaj Mitpal, MD, Optima Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Let's take the first question, which is from Diksha. And good evening, Pankaj. Welcome to the show. We have Diksha's query via email, and she says she's investing 5,000 per month in mutual funds, HDFC Mid Cap, SBI Small Cap, HDFC Flexi Cap, and she wants to add SBI Contra and Nippon India Small Cap Fund going forward. And she's 23 years old and willing to invest for 10 to 15 years or even more. And she's also willing to step up her SIP as and when her income increases. Now, she wants to make a good portfolio for long term. So, Diksha, first of all, congratulations. You are just 23 years old. You've understood the importance of having a long term portfolio. The kind of funds also you've picked up are pretty equity oriented, which also match up your investment time horizon. But then, are these funds good for you? Can you go more aggressive, or maybe you should just down? Let's understand all of this. Pankaj, how do you look at these existing funds? And because she's just starting her investment, you might also want to guide her in terms of aligning her financial goals, which she might have going forward in her life.
Kavita, good evening. I agree with you. See, she has allocation across market cap, She has allocation large cap through flexi cap fund. She has allocation in mid cap and small cap as well. As she has asked about contra fund. So SBI contra fund is a value oriented fund. So it will give some further diversification as far as style is concerned. So she should consider this fund in her portfolio. But small cap, I'll say once she has already one small cap fund in her portfolio, she doesn't need to add one more. So she can skip. She's asked about Nippon India small cap fund. The fund is good, but because she already has one small cap, so I don't think that she should add one more. SBI contra will be good. And as you mentioned earlier about the goal, see, she has mentioned about the funds and allocation is good, but goals are not mentioned here. So what I suggest that any investor, for that matter, when you start investing, first you should decide your goals. Once you know your goals, you know that how much time you have to achieve those goals. Based on that, you can decide that which kind of schemes will be good for you. But here, considering the diversification, I'd say that you should stick to this investment portfolio and add this contra fund as well. But you skip this small cap.
All right. So also a lot of investors are interested in the contra fund, especially SBI contra is leading this category as well, Pankaj. You might want to elaborate on this and maybe help Disha and other investors in analyzing whether this kind of category fits in their portfolio or not.
See, when we talk about value-oriented fund, these are well-diversified funds, can invest across the market cap. But as there are different styles of investment, one is a growth style, another style may be growth at reasonable price, or you can say one is value style. So all these different styles have their importance in the portfolio. And why this fund is in the portfolio of many investors, because in previous few years, we have seen that growth style, value style performed better than growth style. And that is the reason, because investors mostly, they look at the past returns and based on that, they invest. So it does not mean that the contra fund, because it has performed very well in the past few years and the same kind of returns you should expect. But for a long term, when you want to diversify your portfolio, there's the importance for every style. Considering that fact, you can consider whether ICICI Prudential Value Discovery or SBI Contra Fund or any other good performing value fund, but do not expect the similar return what you got in last few years.
All right, let's move on. Let's move on to our next question, Ranjan's question. Ranjan says that his current investment is 30 lakhs and he's doing SIP of 32,000 monthly. He's a government employee and he has retirement, he has NPS as far as retirement product is concerned. In SIP investment is going on in Parag Parekh, Flexi Cap, Kotak Mahindra Equity Opportunities and SBI Small Cap, Mid Asset Tax Saver, and he's also invested in ABSL Tax Relief Fund and UTI Nifty Index also, and he stopped SIP in these two funds, and large cap allocation is almost 50% in his portfolio. He wants to understand if he can exit the two funds where he stopped his SIP and how can he achieve his target.
See, first thing is about ELSS, because there is a lock-in of 3 years and all the units should complete. Means if you are investing through SIP, so it does not mean that when you started from that day, you should complete 3 years, but the units, because when you invest through SIP, so units will be allotted at different time. So the units which complete 3 years, then you can redeem those units. So if suppose you invested for 3 years and you want to redeem all the units together, you will have to wait 3 more years from the end of the date when you invested last time in SIP. So that Mr. Ranjan needs to check that whether his units are in lock-in or these are free to be redeemed. So otherwise, he can definitely redeem those units and reinvest in some other funds. As far as UTI Nifty 50 index fund is concerned, it's a large cap fund. So though as he mentioned that he has a good allocation in large cap. So from that point of view, if you want to redeem, you can think about it. You can consider it. Otherwise, it's a good fund. In long term, we always expect that large cap index fund will give you stable and good returns. So, but there's no lock-in in that. You can redeem anytime if you want and switch to other funds of any category which you feel that will be suitable for you. And as you have allocation across this thing, large cap, mid cap, small cap, I think it's a good portfolio. And as you are investing in NPS, at the time of retirement, you will also get a choice to withdraw 60% of the pension fund as a lump sum, and rest 40% has to be utilized for buying annuity. So that time you can decide that how much pension you want and how much you want to redeem. But you have good corpus, and I expect in 25 years, if you invest, even in excluding NPS, you can accumulate around 10 crore rupees with your 30 lakh lump sum what you have now, and with your SIP of 25,000 rupees per month, you can expect around 10 crore rupees at 12% CAGR. So all the best to you.
We move on. Let's take Ayush Garg's question, Pankaj. He wants to invest 5 lakhs for 9 months with maximum downside tolerance of 15%. And he wants to understand the best investment category.
Kavita, see, for 9 months, it's not advisable to invest in equity funds, but because he has clearly mentioned that up to 15% downside risk he can tolerate, so it means he's expecting little higher returns. So for 9 months, I'll say that Ayush can consider conservative hybrid funds. Conservative hybrid funds means these funds can invest in equity and debt, and equity allocation can be somewhere 10 to 25% of the total asset of the scheme. And at the same time, these equity savings fund, it is another category which invest in equity shares, some small portion in debt, and there can be arbitrage basically. So it's arbitrage and debt combination majorly. So these two categories I can suggest. So in equity savings fund, he can consider Kotak Equity Savings Fund or ICICI Prudential Equity Savings Fund. And in conservative hybrid fund, Ayush can consider like HDFC Hybrid Debt Fund or SBI Conservative Hybrid Fund.
All right, next question from Delhi, Gautam Yadav, and he wants to know the tax implications of multi-asset mutual fund, and do all funds have the same tax implication, or does it depend upon the equity percentage of the portfolio of the fund? Very interesting question, Pankaj.
Yeah, and it's very important because now there is a lot of confusion. There are 3 categories actually for tax calculation, and it depends on how much equity allocation is there. As far as this multi-asset allocation category is concerned, because as per SEBI mandate, there has to be a minimum 3 asset classes, and each asset class, there will be allocation of minimum 10% of the total AUM of the scheme. Now it is up to the fund house how they want to manage. In some schemes, we see the minimum equity allocation is 65%, and there are some funds where equity allocation is less than 65%, but 35% or more than that. So, and I don't think there's any scheme which has less than 35%, but at least 2 types of calculation you will have to understand. So if the equity allocation is 65% or more, then it qualifies for equity taxation, where holding period of 1 year is more than 1 year is long term, up to 1 is short term. Short term capital gain is 15%, and long term capital gain tax on such schemes will be at 10% on the amount exceeding 1 lakh rupees in one financial year. But where the equity allocation is 35% or more, but less than 65%, here holding period up to 3 years is short term, more than 3 years will be long term, and in long term you will get indexation benefit. So the schemes which have allocation minimum 35%, I think this is a very good allocation now, because post-tax returns can be attractive in this case. So as the question is that there are different tax implications based on the equity allocation.
I think that's all the time we have for our viewer queries today. Pankaj, thank you so much taking out time and helping our viewers with their mutual fund portfolio queries. On that note, time to sign off, but I'm going to leave you with our WhatsApp number and email ID to keep sending us your questions. Thank you so much for watching. Goodbye.